Welcome to the Deep Dive. Today is December 8th, 2025. And, well, you can't miss the headline. Bitcoin just decisively reclaimed the $92,000 level.
It's the only thing anyone is talking about.
Exactly. And for a lot of people, that move, it sort of confirms the whole structural bull case, especially with rate cut expectations so high. But when we looked across our sources today, the real story, the tectonic shift, is happening beneath the price.
It really is. The rules of engagement have fundamentally changed. CoinShares, in their 2026 outlook, they have a great term for it, hybrid finance.
Hybrid finance.
Yeah. They're basically saying that the old adversarial phase, DeFi versus TradFi, this hostile battle, it's over. What we're seeing now is a deliberate symbiotic integration.
So legacy liquidity meeting blockchain efficiency.
Precisely. Those massive pools of traditional capital are finally merging with the efficiency and, the scarcity of digital assets.
And we definitely saw that capital flood in.
Yeah.
The total market cap is sitting at, $3.11 trillion? It's completely neutralized those earlier bearish fears.
Mm-hmm. It did. And you have Bitcoin trading around $91,532. And sure, that's being driven by that 85% probability of a Fed rate cut.
That's the fuel, right?
It's the fuel, but the engines, the actual platforms, and the new regulations, that's what we really need to dig into.
Well, let's do it, because it seems like regulation is no longer the obstacle. It's actually the prerequisite.
It's the gateway. That's exactly it.
Yeah.
The institutions demanded structures they could recognize, and now regulators are actually delivering.
And maybe the most dramatic example of that is coming out of the Middle East with Binance.
Oh, it's monumental. They secured what's called a full financial services permission, or FSP, from Abu Dhabi's FSRA.
So what does that actually let them do?
It means they can operate their global platform as a fully regulated entity in the UAE. And that kicks off January 5th, 2026. This isn't just about a local office. It's about setting a new global standard.
But getting that license wasn't easy. It required a total restructuring of their business, right? They had to basically copy traditional capital markets.
That's the core insight. The ADGM mandated this very strict three-pillar model. It's a systematic unbundling of all their functions.
Something U.S. regulators have wanted for years.
Exactly. So you now have three legally separate entities.
Okay, walk us through them, because this really does feel like the template for any global exchange going forward.
Absolutely. So Pillar 1 is Nest Exchange. That's the Recognized Investment Exchange, or RIE. It only handles trading, order matching. That's it.
Simple enough.
Then you have Pillar 2, which is maybe the most important for building institutional trust. It's Nest Clearing and Custody. This is the clearinghouse. It handles settlement and secure custody.
And this is the part that makes client assets bankruptcy remote.
Exactly. Bankruptcy remote. It directly addresses the systemic risk, the fear that haunted everyone after FTX. Client funds are not on the exchange's balance sheet, period.
It's like separating the NYSE from the DTCC.
That's the perfect analogy. And the third pillar is Nest Trading, which is a licensed broker-dealer for handling things like complex OTC deals. By removing all that compliance friction with a familiar structure, our sources say this is the green light for sovereign wealth funds in the Memine region to finally deploy billions.
Okay, so that solves for custody risk.
Yeah.
Let's pivot to the U.S. and capital efficiency with Bitnomial.
Yes, this is another huge piece of the puzzle. Bitnomial is launching the first ever CFTC-regulated leveraged spot crypto exchange in the United States.
A designated contract market, a DCM.
Right. And the killer feature here, the one every institutional desk is looking at, is portfolio margining.
Okay, break that down for us. For anyone listening who runs hedging strategies, this is a massive change.
It's all about netting. So traditionally, if you were, say, long spot Bitcoin but short Bitcoin futures to hedge, you had to post full collateral at two different places.
Tying up huge amounts of capital.
A huge amount. With portfolio margining on a single federally regulated platform, those opposing positions just net out. Your margin requirement is calculated on the net risk, not the gross positions. It just frees up so much capital.
So we've solved custody in Abu Dhabi, capital efficiency in the U.S. Let's go to South Korea, where they seem to be solving counterparty risk with an almost absolute mandate for safety.
It is absolute. South Korea's Financial Services Commission is looking at legislation that would force exchanges to reimburse users for losses from hacks or failures, regardless of fault.
Regardless of fault. That sounds like FDIC insurance for a bank. That's
Yeah.
an incredible level of protection.
It's a profound shift. The rule basically means exchanges need massive balance sheets and insurance policies. The only way to survive that is to drastically reduce your hot wallet exposure.
Mhm.
We're talking 95%, maybe more, of all assets in deep cold storage.
Which would make South Korean exchanges the safest in Asia.
Arguably the safest in the world, but also the most exclusive. The cost of entry will be immense. The whole theme here is that the market is systematically legislating risk out of the system.
Okay, so with that regulatory foundation getting so firm, let's look at how that's translating into direct participation from banks and corporations. Let's start in Europe.
Right. We have France's second largest bank, BPCE Group. They're rolling out direct crypto trading and custody through their subsidiary, Hexarch,
To their retail
which
customers.
is their huge retail base. We're talking about letting people buy, sell, and hold Bitcoin, Ether, Solana, USDC right there in their main banking app.
The integration sounds seamless. What's the scale they're aiming for?
The initial target is 2 million customers. Now, the fees are a little steep. It's like a 2.99 monthly fee plus a 1.5% transaction fee.
But for users who trust their bank above all else, that's a premium they'll happily pay for the security.
Exactly, and this is the real validation for the EU's MiCA regulation. MiCA gave a conservative bank like BPCE the legal certainty they needed to go and build this themselves, not just, outsource it. Legal clarity leads to real investment.
Okay, this is where, for me, it gets really interesting. A whole new investment thesis is emerging in public markets, one designed specifically for Bitcoin accumulation. I'm talking about 21 Capital.
This is a pivotal moment. 21 Capital just listed on the NYSE. Ticker is XXI. It's the first company engineered from the ground up to be a Bitcoin native operating company.
How is that actually different from, say, MicroStrategy? They already hold a massive amount of Bitcoin.
It's a fundamental difference in purpose.
Yeah.
MSTR is a software company that adopted a Bitcoin treasury strategy. XXI's entire business model is capital-efficient Bitcoin accumulation. They're launching with over 43,514 BTC. That's about $4 billion. And they're backed by Tether and Cantor Fitzgerald.
And their whole strategy is based on what analysts are calling the flywheel effect. Can you break that down for us?
Think of it as a perpetual supply-swallowing machine. They issue equity, their stock, XXI, at a premium to the net asset value of the Bitcoin they hold.
And investors pay that premium for the access and the mandate.
Right. The company then immediately takes that cash and buys more physical Bitcoin. That increases the key metric, which is Bitcoin per share. As that number goes up, demand for the stock grows, they can issue more equity at a premium, and the cycle just repeats.
So you've just created a new, permanent, aggressive spot buyer on the public market?
A price-agnostic buyer, it's just systematically intensifying the supply shock and locking up the free float supply.
Let's shift our focus to the high-growth retail markets over in Asia, where it looks like the race is on to build the definitive crypto super app.
And Robinhood is making a very aggressive move into Indonesia. They're not building from scratch. They're going with a buy versus build strategy. They acquired both a licensed securities brokerage and a licensed crypto exchange.
Why Indonesia? What makes that market so critical right now?
The demographics are just staggering. You have 19 million capital market investors and 17 million crypto users. There's this massive overlap. By buying the licenses, Robinhood just leapfrogs years of regulatory hurdles.
And they can immediately offer U.S. stocks, local stocks, and crypto, all in one app.
A true super app. It's a direct challenge to the local players right out of the gate.
Now, contrast that kind of rapid expansion with Coinbase's much more deliberate re-entry into India.
This was a quiet but really critical development. Coinbase confirmed its official registration with India's Financial Intelligence Unit, the FIU. This marks their official return after they had to suspend operations back in 2022.
And India is still #1 on the Global Crypto Adoption Index, even with that famously punitive tax regime.
A 30% flat tax plus the 1% TDS, yeah, it's brutal.
Yeah.
But despite that, the market is just too big to ignore. For Coinbase, this FIU registration is their golden ticket.
A ticket to legitimacy.
For legitimacy with high net worth individuals, with family offices, with the developer community, they need a fully compliant venue. It signals they're serious about India for the long term, especially for their base layer 2 network.
And to make all of this global trading and integration actually work, you need the back-end plumbing.
And we saw a huge validation for that plumbing today. Airwallex, which is a critical provider for cross-border settlements and fiat on-ramps, just announced a $330 million Series G round.
At an $8 billion valuation.
An $8 billion valuation. And their future focus is on a concept that sounds like science fiction, but it's very real: agentic finance.
Which means what exactly?
It just refers to AI agents that can make autonomous financial decisions. Think of an AI managing a company's liquidity or negotiating payments on its own. These agents aren't going to use Swift.
No, they'll need digitally native currency rails.
They will require stablecoins facilitated by infrastructure layers like Air wallets. It's another way crypto just gets further embedded into the global economy as the default for automated value transfer.
Which is a perfect transition to our last section, the long-term strategic vision and the battle for stablecoin dominance.
Right. Bybit, which is the second largest exchange by volume, just announced a strategic partnership with Circle to deepen USDC integration.
They're focusing on liquidity, on-ramps, passive income products.
It's a very clear, very strategic challenge to USDT's dominance.
It seems aimed squarely at institutions.
Absolutely. By choosing USDC, which is, regulated with reserves in U.S. Treasuries and cash, Bybit is explicitly signaling that they want to attract risk-averse institutional capital. They're trying to de-risk the derivatives market by offering a collateral option that big money feels safer holding.
And speaking of big money, Michael Saylor was the keynote at the Bitcoin Mine Conference, speaking directly to sovereign wealth managers in Abu Dhabi.
His message was perfectly tailored for them. He anchored their expectations with that huge $21 million price prediction for Bitcoin.
Over a 21-year horizon, it's a 30% COGR.
It is. But the more critical part of his thesis was about corporate performance, what he calls the zombie company thesis.
Right, that 96% of public companies are zombies because they fail to outperform their own cost of capital.
And so he frames holding Bitcoin not as a speculation, but as a fiduciary necessity for any corporate treasury that just wants to preserve its purchasing power.
Our sources also noted he talked about miner diversification.
Yes, that the $65 billion in AI and HPC contracts that miners have signed is now actively subsidizing network security, which makes miner viability less dependent on just the block rewards alone.
And finally, just a quick reality check from the social protocol Farcaster about what users in Web3 actually want.
Yeah, after 4 years of a social-first strategy, they're pivoting hard to a wallet-centric model. Their data showed that while social engagement was flat, in-app wallet usage was growing like crazy.
So it's an admission that users are there for finance first, friendship second.
It's an explicit acknowledgement. In Web3, transactions are king. Their goal now is just to make the wallet a seamless transactional layer on top of Coinbase's base L2.
So if we pull all of this together, the regulatory structures, the bank adoption, the new corporate vehicles, what's the core takeaway?
It's that we are firmly in the era of hybrid finance integration. Counterparty risk is being systematically legislated out of existence, and these massive new funnels for fiat currency are opening up all over the world.
So what does this all mean for you?
Well, the volatility that we're seeing right now, ahead of that December 10th Fed meeting, it should probably be viewed as a tactical entry point into what looks like a structurally bullish 2026. The groundwork is done, the funnels are built.
The pipes are connected.
And here's the final thought for you to take with you tonight. The listing of 21 Capital creates a permanent, almost price-agnostic demand for Bitcoin. When you combine that with corporate treasuries and these new regulated fund flows, they're all systematically locking up the available free float supply. So ponder this. Is the floor price of Bitcoin now rising fundamentally because of this structural supply absorption, completely regardless of short-term retail sentiment? That's your homework for the night.